Welcome back to the Investing Show. We're joined now by Justin Urquhart-Stewart of Seven Investment Management. Justin, welcome to the show.
Pleasure.
Thank you for joining us again.
Thank you.
Now, obviously, a lot of the discussion over the past couple of weeks, months, has surrounded that one big issue, Brexit.
Yeah.
And if ever we were in danger of looking too inward with our investments, I would imagine that it's now. But this obviously presents an opportunity to look much more outward, doesn't it? To say, well, look, we've got this little scenario going on at home that's going to occupy our minds for a couple of years, but what about the rest of the world? So, where are you looking around the rest of the world?
It is a classic moment, isn't it? Because it is one of those times when you've just been going around the place and everyone's been muttering, oh, we're doomed, everything's going to be dreadful. The rest of the world's doing quite well. The global economy is growing at over 3%, over 3%. The IMF have slightly brought down their long-term view, but not by very much. So you look at the United States, and again, despite what the politicians seem to be saying, the US economy is doing really rather well. So there's not things there which should be ignored. People say, well, hang on, the S&P is at all-time high. But then again, so is the US economy. So actually, that's not necessarily so expensive. Go out to Asia. And you can see there, the Chinese economy is still doing all right. The Indian economy, despite people saying, well, Modi's having a difficult time, well, compared to a lot of other emerging markets, we haven't had things like coups or other bits and pieces going on, it's doing okay. So a very good chance for people to actually look around the world and say, what's growing, where's value? The downside we've got at the moment is sterling's weaker, so we're not buying as much as we could before. But nonetheless, in the longer term, if you think that sterling's come down, already taken the worst of the news, I suspect, maybe still further weakness to come, but the worst is probably there. Actually, here's a good time to go and pick up some particular assets. And the ones I particularly like, if I look at the United States at the moment, it is fully valued, but the action taken on banks in America has been much more effective than you've seen in Europe. And actually the value there, they haven't really caught up with everything else. So an index on American banks I've been looking at, and I'm quite interested in that one. Mm-hmm. I've also then been looking back in the Eurozone, because again in Britain everyone goes after Brexit, whoa, that's all going to be terrible. Well, I wouldn't touch on the Eurozone banks, but the smaller mid-caps and smaller indices actually for the Eurozone, again, these are companies which are not really affected by Britain at all. They're not exporting to Britain, they're actually exporting to a lot of the emerging nations. And so those companies are actually still in a really rather good position, which then brings me then to the emerging nations. I still like India as a long-term area, as with also China as well, simple access to that. And my home turf back in ASEAN, down in Southeast Asia, although Malaysia is obviously hit by oil prices, that's been recovering. Indonesia is still one of those businesses, and the rise of the Oriental consumer is something which is not going to be going away. So when I look around the world, there are lots of choices here to look at.
And when you look at people's portfolios, you know, as a professional, do you think that probably, and I guess everyone tends to do this, whatever country you are in the world, do you think there's too much home bias?
Nearly always. One, because sometimes because the advisors, that's the only thing they know. Sometimes because that's where they're paid commission on, heaven forfend. But actually there is a bias because that's what they're familiar with. In Britain, it's obvious because actually our FTSE 100, as we've all discussed before, actually is very international anyway. So by the very fact we're investing in a lot of those FTSE 100s gives you a pretty good global view. But nonetheless, we tend to have a UK bias and we tend to have a sterling bias. Again, not surprising because most of our liabilities and most of our requirements are going to be back in sterling. But we should look around the world because there's an awful lot going on around there which otherwise we would miss out on. And if you want that good, longer-term, successful portfolio with good diversification, it needs that time to do so. And it's never been easier. When we were growing up doing international trading, it was really expensive buying overseas stocks. You got ripped off by the overseas broker, you got ripped off with nominee charges and custody charges. By the time you got your dividend through, assuming you ever did, after the exchange rate charges, it wasn't worth having. You don't need to do that now. We've got some of the best indices structures we could ever have.
Let alone having to deal in board lots in certain markets, and in round numbers. If you had odd scraps, they would take another day or two to try and dispose of. Just in terms of the States, it is interesting. You're absolutely right. US companies at the moment are, of course, more profitable than they've ever been. What do you think of the natural turnout that we've had over the last 40, 50 years, whereby in those days gone by, US companies were mostly valued on assets and tangible worth, whereas as we know with the internet and the Internet of Things now coming along, it tends to be about brands and trademark and intellectual property. So I guess in that respect there's a bit more sort of guesswork going on in terms of valuations. Is that something as world leaders the US are on top of?
I think we need to be careful of that, because you need to therefore look for those companies where you do actually have some real value.
Yeah.
I'm concerned that last year's the fangs that we had last year that we all were rushing off to, a lot of that is an awful lot of hype in there. They're perfectly good companies, but that's some serious value. I prefer looking at what the consumer's been buying, in terms of what the house builders have been doing. That's good old-fashioned solid stuff. Now, of course, we do have this rather strange election coming up with a choice which is pretty unpleasant for most people, for most Americans I can work out. We've got rather a strange, follically challenged buffoon on one side and a dear lady who seems to be rather slightly suspicious in ability to tell the truth on the other. The good news is they don't control the economy. That's with the Fed. And so actually I have much more faith in Ms. Yellen. The concern I've got in the States, and again this must be in our portfolios and we should think about here as well, and you were just talking about with Moose, was actually the issues, what's going to happen with some issues on inflation. There are some inflationary pressures there. And therefore we should just keep a weather eye on this, because no one ever expects it, to actually, and then suddenly think, oh, didn't we see it coming? Well, the oil price has gone up quite a lot. That will start feeding through into the annual figures. And that's rippling through the rest of the economy. Sterling's dropped as well. That'll be inflationary domestically. So just something else for us to consider, both domestically but also internationally as well.
Practically speaking, for an investor who looks at their portfolio and goes, yeah, I've got way too much home bias. If they're an individual, share buying investor, then obviously it's going to be much harder for them to do that assessment on a foreign company, perhaps. I mean, the fundamentals are essentially the same. You should be able to do it. But whilst maybe you can assess a company like a Facebook or an Apple, you can go, I know that company, I know their product, I know what they do. It can be much more complicated if they want to go off and try and buy individual shares in an Indian company, for example. So presumably, if you're looking to spread your wings that way, you need to be looking at funds, at trusts, at ETFs. When you're looking around the world, do you go for an actively managed option or a passively managed option, or do you do it depending on where you're looking at?
A combination of both. You're quite right about the stocks, and you're quite right particularly when it comes to the research on those stocks as well, because you don't have to go far from these shores to actually find some pretty dodgy research being given on companies, quite often by the companies that are actually advising them as well. So that's highly unreliable. No, you will have to go via funds. I like using low-cost passives where I can, but there's some very good active managers. The trouble is choosing them. Now, we have teams of people just selecting managers, and they don't always get it right, so it's really rather difficult. And you have to find people who've got a track record there, but you will be paying more for it. You pay more, but you expect them to be outperforming. Only 20% will. 80% tend to hug the indices, in which case, buy an indices. You can buy an index really very cheaply indeed. There's some perfectly good investment trusts, I wouldn't ignore those, but perfectly good ETFs would actually get you some good exposure as well. So that to me is a simple way of doing it. They're cheap to run, they're easy to trade as well, which for the private investor who actually then has a sort of moment of concern to be able to act quickly, that's really important.
I think the other thing, in terms of the world's largest market, is worth mentioning. The US market remains and has always been full of heavy shares. In other words, they tend to be much higher priced individually, so you tend to get a bit less bang for your buck unless you're really going in with a fair size order. And then there's the tax implications. There's this horrible thing called the W8 Ben form, which you have to fill out for individual US shares, although admittedly, rather like the US visa, it lasts for about 2 years before you have to just sign a piece of paper again. So there may be some local things to watch out for, which you are totally bypassed by having funds.
And liquidity as well. We used to markets where it's easy to trade, but you don't have to go much beyond our own 350, and if you find life's a bit thin. But you go to some of these more extraneous, exciting markets, and it may sound dynamic, but you could be the proud owner of something which no one else wants to buy. In which case, go via the fund. It's considerably easier. It's somebody else's problem.
Looking outside, obviously, the individual markets and the individual regions. What about going into other assets? I mean, what are your thoughts on gold, for example, at the moment?
Well, I think there's a classic moment when we've got our Brexit fears. We have no idea what's happening. People are concerned. And if there is inflation coming through, then solid assets are there. Now, you were discussing with Moose what's happening with property prices. We're all familiar with that. Gold has been a good one. We bought a lump of gold earlier this year. Bought 6 tons of gold actually earlier this year, which turned out to the same amount as Lithuania. I'm not sure if that's good news or bad.
As you told me that, I really hoped that you had gone out and actually bought 6 tons of
6
gold
tons
and
of
were
gold.
storing it somewhere, Justin,
But-
not having bought it through an ETF.
It is physical, but it is physical through an ETF. But I wanted to know what 6 tons looks like, and actually it's about the same size as that table.
Yeah.
And that's it. I was really quite proud. I thought this whole sort of, I was expecting something out of Goldfinger. Or
Aren't
something.
there only a couple of swimming pools worth in the world or something?
It's tiny,
Yeah.
isn't it? The actual physical amount is very small, the size. So yes, that's already come a long way. And at moments like this, actually, and you are concerned about inflation, and you're concerned about actually what's happening with Brexit and things, I like gold. And something which I certainly don't advise on at all, this is purely a personal preference of mine, I have always owned a few cases of very extremely good claret. On the basis that if things do go wrong, I've got a reasonable asset, and if it's really that bad, I can always enjoy it. Probably in about 30 years' time.
And obviously, when we're talking about, saying, right, well, I like the look of India, or I like the look of Indonesia, or I like the look of gold, we're not talking, for individual investors about going, well, go pile all your money into India, go pile all your money into gold, go pile all your money into Indonesia. It's about tilting a portfolio, isn't it?
It really is. And this is where it comes back to that overused phrase of asset allocation, but it is really very important. So gold may just be, maybe it's 4-5% of your portfolio. If you're talking about emerging markets, that's probably not going to be much more than 10, maybe 15% of your portfolio. So there are subsets there you can make. And for those that are frightened by it, if you want good commercial exposure around the sea, overseas, domestically can do it for you. The likes of Diageo, the likes of Unilever and Reckitt and Benckiser, we know their products, you can see them around the world. That's as much an international investment without having to go very far. But no, I like to spread the asset allocation around the globe, across those different asset classes as well. Inevitably, there's going to be a greater weighting towards sterling, because I'm a sterling investor. Most of my clients are sterling investors. That's what they've got to come back to. And there is a greater weighting propensity as well towards equities, but not at the old levels of equities we saw in our old stockbroking days of when it was sort of 70-80%. It's down to about sort of 50-55%. Actually, it's probably slightly higher than that now. But fixed interest lower, but a greater increase now of these alternative asset classes. The problem is we don't have enough of them. We're busily trying to dig out and trying to find different areas and different types of things we can try and invest in.
Justin, that's all we've got time for today. Thank you very much for joining us.
Pleasure.
Richard, thank you very much.
Pleasure.
Thank you very much for watching. Join us next time on The Investing Show. Goodbye.